Welcome to episode 75 of the 5-Minute Investor, the podcast where we break down stocks at the heart of two stories shaping your investing week. I'm Trevor Abes.
And I'm Jonathon Brown. This is what we look like. Each week, we bring one stock, one headline, and one reason investors should care.
To celebrate our 75th episode, we're going visual with a detailed examination of two movie-related stocks whose profitable underlying companies and established market share make them strong choices to capitalize on 2026, being on pace for the movie theater industry's best year since the pandemic. John starts us off with a picks and shovels play with a household name.
Picks and shovels, I like it. Well, this is a name you probably all know, even if you don't realize it, but it's Dolby Laboratories, DLB on the New York Stock Exchange. Now, who are they? Well, Dolby, they develop audio, picture technologies that make movies, TV shows, music, games, even live events, makes them all sound better and more immersive. And they license those technologies to device manufacturers and streaming platforms, broadcasters, and cinemas. Now, Dolby generates much of its revenue through licensing agreements, and that allows its partners to embed Dolby tech into products and services.
Okay, sounds like a solid business model, John, but how has that translated into Dolby stock performance?
Well, there's some good news and bad news, and that's what makes this story pretty interesting. So, got to be honest with you, since the year began, Dolby stock has lost around 1% of its value, and it's about 13% lower than where it was this time last year. But there is some good news to this story. I've been looking since the summer began, and I found that DLB stock, it's risen nearly 20% as of this recording, and it trades between 55 to 60 US dollars.
And what do you think caused the bump?
There's been a lot of good news coming out of Dolby lately. I wrote an article on this over on Stockhouse that goes into a bit more of a deep dive, if you will. But earlier this month, they started rolling out Dolby Vision 2. With Hisense TVs that'll be equipped with it. Hisense is a very popular TV brand. Maybe you've heard of it. I've got one. Lots of people have one. They had a big presence at the FIFA World Cup this year. Peacock was using Dolby audio and video to stream. I believe I read somewhere that was the first time it's been used for streaming the World Cup. And Android is also rolling out Dolby sound in some of its BMW, Mercedes, and other models of cars. So they're at the theater, they're at your home, and they're on the road. Everywhere you are. Dolby, they're with you. And this is probably for the other half of the question, why do stocks go down when the news is good? It's kind of weird. That's a whole other story in of itself. But stocks, they often rise in potential, but they fade when the news gets out, even if that's good news.
Okay, this brings up another question, John. Are there any near-term catalysts coming up for Dolby that you could see?
I got a prediction for a pretty good one, I think. Mark your calendars. Keep an eye on this in theaters. A big movie coming out called Avengers Doomsday. Maybe you've heard of it. December 18th. It's expected to generate over $1.5 billion to $2 billion US dollars is the prediction at the box office. And the new trailer that came out, it's promoting that the movie is showing in Infinity Vision. Is it a buzzword? Probably, yes, it is. What is Infinity Vision? Screens have to have certain criteria. One of the criteria to apply or be applicable for Infinity Vision is Dolby Atmos for the immersive audio. It might end up being something maybe equivalent to what IMAX is doing with the Odyssey. You know how popular it is and how hard it is to get to an IMAX showing of the Odyssey. I don't know if this is going to be on that level, but it sounds almost as impressive. And it's definitely going to be something that's going to get the Dolby name out there even more than it already is. Now, there's some more news I got to make you aware of. Dolby just released its Q3 2026 financials. Revenue seems to have flatlined quarter over quarter, but it's better than going down, and year over year. But management is forecasting higher full-year revenues and a boost in Q4, so watch for that.
Okay, got another one for you, John. Everybody knows that theaters aren't really kings of the entertainment world anymore, but has their decline impacted Dolby's business?
It's true. Theater business has taken a hit since the COVID pandemic. Going to movies is very expensive. People have good setups at home. Streaming, movies come to streaming sooner and sooner now. So it's like, what's the point to even going out to the movies anymore? But it seems like Dolby's got this all covered. We've seen a resurgence in the theater experience lately. AMC in the US and Cineplex here in Canada both have made reports about a recent boost in their business. We've covered this on Stockhouse, and you can see the news where they go into more detail on that. And Dolby isn't just in cinemas either, but home theaters, and they're becoming part of vehicles like we're talking about earlier. And I think what's most important is that Dolby's been around for decades. I've even got cassette tapes. Remember those upstairs, Dolby cassettes? And there's an obvious reason for that.
Let's sum things up, John, with one last question. What, in your opinion, gives Dolby a competitive advantage in this increasingly crowded media technology market?
Well, in my very humble and accurate opinion, Dolby has a household name recognition, decades-long industry leadership, longer than we've even been alive. And they've got a deep integration into the global entertainment ecosystem. So investors have plenty of reasons to keep this high-margin licensing powerhouse on their watch list. But next up, Trevor's going to shift from the technology behind the movie experience to a company focused on delivering it.
That's right, John. The cinema-centric stock I have for you all today is the Marcus Corporation, ticker MCS on the NYSE, market cap $935 million US at the time of recording. It's an almost century-old company that diversifies its ranking as the fourth largest US movie theater exhibitor with a high-quality hotels and resorts division.
So what sets Marcus apart from the larger players in the movie theater space?
Well, from a high level, John, the company owns about 62% of its theaters, compared to less than 10% for its peer group, which differentiates it through strong underlying credit support, lower lease payments, as well as enhanced free cash flow. On the ground floor, Marcus's more manageable portfolio, spanning 975 screens at 77 locations across 17 U.S. states, has allowed the company to focus on offering viewers a more premium experience, including dream lounger seats, large screen formats, expanded food and beverage options, haptic and motion seating, and even a purpose-built sports viewing auditorium. Additionally, the company operates a growing and profitable hotels and resorts division, like I mentioned, spanning more than 4,650 rooms across 17 owned and managed properties, adding flexibility compared to pure play cinema companies that must live and die by the sway of popular sentiment.
So in your coverage of the company, how is Marcus's diversified offering played out in its income statements?
Well, leadership has done, I think, a good job of pairing growth with profitability, growing revenue from $458.2 million in 2021 to $758.5 million in 2025, while growing adjusted EBITDA from $35.1 million to $99.3 million, respectively. The snapshot in the first half of 2026 has been no less impressive, with the company taking in revenue of $242.1 million, up by 11.3% year over year, and adjusted EBITDA of $44.3 million, up by 46.6% year over year, while more than doubling net income, supported by healthy demand for leisure and in-theater experiences alike. And Marcus will even pay you to wait as it pursues numerous ongoing growth initiatives across its divisions, offering you a quarterly dividend that currently stands at 34 cents US per year. You can check out the episode's show notes on Stockhouse for more information on the company.
So our listeners and now our viewers, hello, they understand that Marcus has a captive audience, and that company is proven quite skilled at serving it profitably. So the pressing question then becomes, how have investors reacted to the increasing strength of Marcus's business?
I think the answer to your question is effusively, John, but also skeptically. Because while Marcus stock has added about 100% year over year, in line with rising revenue and cash flow, shares are up by only 106% since 2021, which feels excessively pessimistic, if you ask me, given that the company has done nothing but generate value since emerging from the COVID pandemic.
As always, you can find links to the articles from today's episode in the show notes and more investing insights on stockhouse.com.
And you can find the 5-Minute Investor on Spotify, YouTube, iHeartRadio, Stockhouse, or wherever finer podcasts are found. This podcast is produced in partnership with Dolby Laboratories, Inc. and the Marcus Corporation and is intended for informational purposes only. For full disclaimer information, please visit stockhouse.com/legal/disclaimer.